Starbucks actually had a great Q2. However, they were pulled backwards by weak results in China. So the question is, what is the look through for Starbucks? And is the company cheap enough for us to buy it at this moment? That's what I'm going to cover in this video. So guys, smash that like button, subscribe if you're new, and of course, drop a meow in that chat. You're watching More Money. Let's get it. What's up, guys? And I was very surprised at Starbucks results this past quarter. You can see that Starbucks said that US consumers are not trading down or reducing their spending on coffee despite the higher levels of inflation. I personally think that this may not necessarily be sustainable if the economy continues to weaken. But notice that China's same-store sales fell 44% during the company's fiscal third quarter. So China, disaster indeed. But you can see that overall, the company did do well. Global comparable same-store sales increased 3%, and it was driven by a 6% increase in pricing, but of course that was partially offset by a 3% decline in comparable transactions. So the transaction volumes are actually down. But note here that there's two things weighing on their results. One is a stronger US dollar. So with foreign currency translations, it actually makes their international operations look weaker. So that's a read through of companies that do have international revenues. Now, the other thing is, notice the COVID-19 related restrictions and China's commitment to their zero COVID policies and what it's done to results in China. And what that does is it really speaks to how devastating these measures have been to the local economy there. However, remember, guys, that China is actually trying to turn things around. They're trying to push housing construction, and they just lowered their interest rate to sort of juice the economy in Q3 and Q4. So you could have a turnaround here where Starbucks actually reports higher international results driven by China in the third quarter, or I guess their fourth fiscal quarter. And here's something that Starbucks reports, and I really appreciate that they do it because it stops me from having to do the math. I'm very impressed because my Patreon model expected higher commodity prices to weigh on profitability, and that would push down operating margins. However, notice that the operating margins did not decline to the 13% range that I was expecting. Instead, Starbucks' pricing was actually really strong, and they're running at that 14% range. So that's really good. And so I actually updated my model to increase that operating margin going forward. But before I go into that, I want to show you what the analysts are thinking. Notice that Starbucks has mixed to positive analyst ratings with a $92 per share price target, which reflects an approximate 10% premium to the closing share price as a recording of this video. So the analysts aren't too bullish in terms of their share price target for 1 year out. And notice that this is the model that I provide to the Patreons. Notice that I now expect strong margins for the remainder of 2022, and I expect revenue to grow in the high single digits into the medium term. So notice that 14% is highlighted at the bottom. Now, Starbucks very well could get to their regular sort of operating profit margins of around 16% in 2023 and beyond, but I'm just giving them 14%. Call that some conservatism in my model. Now, before I give you the valuation for Starbucks, notice, guys, that approximately 80% of the watch time that this channel is getting is not from people that are subscribed. So if you're not subscribed to the channel, please take a second and hit that subscribe button so that you're notified of all the great content that's coming out on this channel every day. So now moving on to my valuation, notice that I'm using a lower multiple than Wall Street is, and I'm also penalizing Starbucks for having large amounts of debt on their balance sheet. So according to my model, Starbucks is slightly overvalued at the current share price because I'm valuing them at approximately $60 per share, and the current share price is approximately $84 per share. So I'm waiting for this stock to come down. But Starbucks is once again one of the best brands in America and globally, and it would really help my portfolio if I have this name in it. But once again, I'm not going to buy it unless I can get it at approximately 50% of its intrinsic value. But that might actually be a pipe dream. I may not ever get it at 50% of its intrinsic value, but that's okay. I'm willing to wait. And why am I willing to wait? Well, you can see here that although Starbucks may not necessarily be an opportunity at the moment, there's at least 7 companies right now that are trading under 50% of what I believe their intrinsic value is, and approximately 20 names that are less than 75% of their intrinsic value. So you can see Best Buy there, there's Sprouts, there's Facebook, there's LGI Homes, and of course there's Alibaba. So there's lots of opportunity. And how do you get access to this tracker that tracks in real time the share prices as a percentage of what I determine their intrinsic values to be? Well, you can get access to all the models at the lower tier of the Patreons. And if you want to join us for an epic live presentation each month where I reserve my very best work for, you can join us at the upper tier of the Patreon. Now, although things are looking good for Starbucks, I believe that there could potentially be trouble on the horizon for Alphabet, the parent of Google, and actually go through that in this video right here.